the Federal Reserve set to kick off its annual economic policy symposium in Jackson Hole. That'll be later this week. Joining us with what to expect is former Philadelphia Fed President Patrick Harker. Patrick, good to have you. There is some expectation we're not going to get much of anything given Warsh's reticence. What are yours?
Yeah, so he does not like forward guidance, that's for sure. He doesn't put a dot on the dot plot. But I do think he has to address the three elephants in that room. It's not a very big room, but there are three. One is clearly inflation. He's got to say something about this. He can't just keep saying, we're committed to bringing it down. That went over poorly at his last press conference. He's going to have to address it. He may not give forward guidance, but he's got to say something. Second, he has to talk about what's going on in the Treasury market and the limits of what the Fed is willing to do there. That's really important. And third, the biggest of all the elephants in the room, we got into this situation in the Treasury market because of the fiscal situation we're in. And, what we're doing right now, what Secretary Bessent's doing right now, is that buyback is building a bridge. But, somebody's got to actually build the road to solve the fiscal problems.
Yeah. All right. Well, you say he's got to answer these three questions, but what if he doesn't?
Well, I think the markets will react again. That's what they're expecting. They're expecting something on at least two of those three, and I would say all three.
It comes also, Jackson Hole, it feels like an inflection point in terms of the strategy between Treasury and the Fed. I think Bill Dudley had a nice piece titled this morning, quote, "The Perils of an Interventionist Treasury and a Passive Fed." How does that change the calculus of what we're going to expect to see later this week from Jackson Hole?
Well, the Fed should be, and I hope they are, consistent. You can't be in the business of, say, getting into the buyback program, which some would label QE, but it isn't that. At the same time, saying you're going to go fight the good fight on inflation. At best, they need to hold rates where they are right now. We have not solved the inflation problem. And there are going to be some of my former colleagues who will want to raise. As we saw, we had 3 dissents, but 2 others have come out publicly and said they wanted to raise. I understand their position. And so he cannot be buying treasuries and at the same time trying to say he's tough on inflation. That doesn't fly.
Are Bessent and Warsh sort of on opposite sides here? And I'm curious as to whether you could posit any guesses in terms of the dynamic between those two right now.
Yeah, I can't. Honestly, I think Jay's just taking a back seat, trying to just be a good citizen. Let the new chair be the new chair. He's not trying to be a shadow chair. I'm pretty sure of that.
I think this is a really good time to analyze the correlation between oil and government bond yields. If the 2-year, the front-end sector, is leading and guiding that relationship, then that naturally becomes a curve flattener trade because central banks have to hike rates to combat sudden inflation, even if it is supply-driven. But if the belly of the curve, the 10-year yield, starts to be in the driver's seat, then that's a different equation altogether. That's what we're seeing right now, where the correlation between oil and U.S. Treasury yields has moved. Now, that tells me that inflation and risk premiums are now baked into the yield curve. And that adds an extra hurdle to jump over when you're thinking about growth and when you're thinking about returns. A very different conversation. And it's very important to think about the belly of the curve as well as the most liquid. We see that a lot in U.S. Treasuries where it is heavily churned, but we see it even more in the gilt market, for instance, because the belly of the curve is actually the intersection of liquidity and speculation. So that's where I'm personally going to be watching, thinking about Jackson Hole, looking for any underperformance versus U.S. Treasuries.
Andrea, let me pick up on that point because, of course, Kevin Warsh is going to be facing a test when he speaks at the Jackson Hole Symposium. And what are markets going to be watching out ahead for in his speech?
Jackson Hole is going to be an excellent opportunity to reassure the bond markets, if anything, but he's going to need clear and realistic communication here. There's been a lot of missed goalposts lately, just starting with Scott Bessent. Initially, he wanted the 10-year U.S. Treasury yield to be below 4% in order to keep government borrowing costs affordable. And Kevin Warsh, of course, has been talking very tough on that 2% inflation target, which has been missed for over 5 years. This is a good opportunity to recalibrate expectations, especially after that loss of credibility in July's FOMC. And this is an opportunity to move us not so much away from forward guidance blindly for the first time in 18 years, I might add, but also guide us toward that credibility again.
And Rebecca, bringing you in here, how much of the equity rally that we're seeing, particularly, I mean, in the States, is relying upon the idea that the central bank, the Fed, is going to eventually cut interest rates?
That is one of the factors, but one of the most dominant factors driving equity markets in the US is the AI trade. It is the growth that we're seeing in terms of the AI capex and the hyperscalers, the extent to which they are investing in data centers, and that filters through down the whole value chain. So you mentioned earlier NVIDIA's results on Wednesday after the close. That is an important bellwether for the whole AI capex cycle. Whether the results themselves are one thing, but I think what's more important is what the guidance is from the business in terms of the sustainability of that growth, but also the profitability of the business. Because given the concentration in markets in that AI trade, any hint of a deceleration in AI capex spend would have ripple effects across US markets, but also across Asian markets.
And Rebecca, how does that impact your view then in terms of European equities? Of course, they don't have as much of the exposure there in the UK and in the European markets as the US.